Raw market data is an overwhelming barrage of shifting numbers. For most, attempting to process this constant stream of information leads to immediate cognitive overload. Making sense of this noise is the only way to answer the 4 questions that define a trade: when to buy, when to sell, where to set a stop loss, and when to take a profit. Without a structured system to interpret these movements, price fluctuations look like a product of arbitrary chance. Sustainable success in the market relies on identifying repeatable structures within those fluctuations, rather than trying to guess the direction of random numbers. In the year 1700, the center of this struggle was the Japanese rice trade. These markets were high-stakes environments, where merchants traded physical rice coupons based on daily price shifts. A trader named Munehisa Homma spent years studying these shifts, looking for a logic behind the volatility that others ignored. Homma identified a direct link between rice prices and the emotional states of the merchants on the floor. He saw that the market was a reflection of the collective fear and greed of its participants. Because human psychology is repetitive, these emotional drivers created specific, recurring patterns in price behavior over time. This repetition meant that if a trader could visually capture these behaviors, they could move from simply reacting to the past to anticipating the next likely move in the market. To capture this psychology, Homma developed a visual system, eventually known as the candlestick. This system allowed Homma to dominate the rice markets, amassing a fortune that made him one of the most successful traders in Japanese history. To understand how it works, we look at a single trading window. We plot the open, the exact price when trading begins. During that period, we track vertical extremes, the absolute lowest point reached and absolute highest peak achieved. Finally, we mark the close, the asset's value when the window shuts. The space between open and close forms a thick rectangle called the body. Thin lines extending to the extreme high and low points are shadows, or wicks. These 4 data points create a single shape that summarizes the battle between buyers and sellers within that fixed window of time. The physical structure of this shape reveals which side won the battle for that day. A bullish candlestick represents upward momentum, signaling that buyers were in control of the price action. In a bullish candle, the price grows. The open sits at the bottom of the body, and the close is at the top, showing that the value increased during the session. Conversely, a bearish candlestick represents downward momentum and a victory for the sellers. A bearish candle shows a loss. The open is at the top of the body, and the price falls to the close at the bottom. By recognizing these 2 variations, a trader can identify the emotional direction of the market at a glance. Homma's system was eventually formally recorded in Japanese and, over the centuries, translated for markets across the world. What began as a way to track 18th-century rice prices has become the standard language for technical analysis used by every major financial institution today. When you look at the complex screens of a modern trader, you are seeing the same symbols Homma used 300 years ago. Modern traders are utilizing an 18th-century master's visual blueprint to decode the same buyer and seller behaviors that have defined markets for centuries.